This week on Retirement Approved, there's gold in them hills, or at least we're going to talk about gold. And we got some little nuggets of information and wisdom to share. As a matter of fact, we're going to share the ebook as well. So let's get into it this week here on Retirement Approved with Matt and Steve Paul. Hey everybody, welcome to the podcast. Thanks for hanging out with Matt and I and Steve and I as we talk investing, finance, retirement. And guys, we're going to talk a little bit about gold this week. You guys got a new ebook, Nuggets of Wisdom. Clever. I like that. And we're going to make that available for folks to check out on the website. So we'll have the links in the show descriptions for you guys to go check this out. But talk to me about what's going on here with the gold conversation this week.
Well, gold is reaching all-time highs day after day, it seems like, and it's the hot topic right now. So we want to do an ebook. It's called Nuggets of Wisdom, available at retirementproof.com. Just talking about how you can incorporate gold if you want to. So some tips there, some things to look out for. So download that, retirementproof.com, click on the gold episode, or it'll be at the link in the description as well.
All right. Yeah, for sure. And as usual, we've got slides, right, Steve? So we can go through some stuff here.
Absolutely. We wanted to talk about gold today too. We got gold bugs kind of coming out of the woodwork right now, bragging. Finally, they can brag. It's been years. but we kind of just wanted to go over today the proper allocation, what we really like, what we're recommending to clients at this point, and it's really in that 1 to 5% range,
right, or that 0 to 5% range. But let's throw up the price of gold here. So this is since we got off the gold standard in 1971. So really, there was a nice run after we went off the gold standard as people could buy it freely. And then it was pretty stagnant from 1980 to 1999. And this is where we see a quote from John Bogle, founder of Vanguard. So Vanguard is famous for stocks and bonds and pretty much nothing else, maybe some real estate if they're getting crazy. So really traditional finance assets. They don't have a gold ETF. They don't have Bitcoin ETFs. They don't have anything out of the norm. So their opinion on gold is it's a speculative asset, which it is. It doesn't have dividends. It doesn't have intrinsic value like stocks or bonds that pay interest. So it's a very different asset. And you can see Jack Bogle pointing out from 1980 to 1999, gold was down about 40% or so. So that is pretty much the case against gold, is you can have these long time frames where gold doesn't do a heck of a lot.
This year, it's doing a lot. It's leading the way. So we're getting a lot more questions on it. And, I was watching some gold podcasts leading up to the show. And one of the questions they always ask is, would you rather own this pretty gold bar or this toilet paper over here, this dollar bill? And it's, which one would you rather put in a vault for the next 20 years? What do you think is going to do better? And it's like, well, yeah, okay. I'd rather own gold versus just storing $1 in a vault. Yes, I get that. But you're not just going to hold onto those dollars. You're going to invest them. And if you look at what the S&P has done versus gold for the last 50 years, you're going to like the returns of the S&P 500. You got the gold bugs going, well, look at this year. Just look at this year. And it's like, I don't want to just look at this year. Let's zoom out a little bit. And they're going, no, don't zoom out. Just focus on this year. It's like, let's go back to 1971 when we got off the gold standard, and let's compare the S&P 500 to gold. What would you rather own during that period? And I understand it. I'm not anti-gold here in any way. I understand you still want to own gold. It's a defensive asset. It's just like fixed income. You want fixed income in the portfolio. Equities are going to be volatile. They're going to go up. They're going to go down. You want stabilizers in there. You want to generate safe income from fixed income. You want defensive assets like gold. I get that. But long term, you want to own the S&P 500. You want to own the market. It's going to outperform. When we get into this last year, yes, gold has done really well. I get it. Some may say it's because central banks are now buying it. Some may say it's because they're finally selling it at Costco.
Wait, you can get gold at Costco?
You can get gold at Costco, and they can't even keep it stocked. I went to their website to see what the price of gold is, to see what their markup is, and it's out of stock every single time I go there. And I'm like,
really? Okay.
To say it's because they're selling it at Costco finally, but the financial advisor in me wants to say it's because the central banks are buying it up.
Right. Well, you might not be wrong. Well, I don't know, guys. Look, I mean, gold seems like it's been flat forever, right? At least that seems to be the case. And again, I'm not the pro here, but my theory has always been it was a great thing to use as a gift for a loved one. But I don't know that it was a very. I mean, I guess if you want to have a little piece as an asset, right? Maybe, but just not go crazy. Like, I guess for anything, right?
You go back to this really basic chart, and when we came off the gold standard in 1971, gold did outperform for a period. But I mean, you look at the years after that, it's really not even close. So again, as a defensive asset in the portfolio, in times of high inflation, high geopolitical risk, it's going to do quite well, like it's doing this year. But long term, again, it's a 1% to 5% allocation recommendation, 0% to 5% allocation recommendation from us. You want to own the market; it's just going to do much better long term.
And we were talking about Costco. We were talking about central banks. Let's just throw up this excerpt from a Reuters article talking about what's going on. So this was from a couple months ago. They were talking about how gold has done so well this year, and it's because of a variety of factors. So number one, we're entering a rate cut cycle. Number two, geopolitical tensions across the world. And number three, demand from central banks, and in particular China had been buying up a bunch of gold. They had bought for 18 consecutive months, and it looks like they've hit the pause button on that because the price of gold has gone up and up and up. But that's the reason that we're seeing gold really, really run. And then let's just look at one more chart, this global turmoil chart. So this is overlaying times of war with the price of gold, and you can see obviously back in the 70s, coming off Vietnam, higher inflation. We had a nice run in the 70s. Then we fast forward to the war in Iraq. So gold in the early 2000s did really well when that was the lost decade as well, 2000 to 2009. So you would have had a dramatic outperformance there. And then, of course, we go to Russia, Ukraine, Middle East turmoil right now. You're seeing the price really take off.
Gee, so conflict, people want gold. Interesting, right?
And then you look going forward. What is it going to do? Is demand going to start going down for it? I mean, you look at who's buying gold. Older generations. The boomers are buying gold. They're boomer rocks. They love them. But you look at younger generations. I mean, I'm 40. I don't have any gold in my portfolio. You talk to a 20-year-old and it's like, do you own any gold? It's like, why would I own gold? I don't want those. I don't want those boomer rocks. Get out of here.
Boomer
rocks.
Well,
yeah. What do you own as a hedge to the dollar or geopolitical risk? And it's like, I own Bitcoin.
I was going to say younger.
Gold.
Yeah. Crypto. Yeah.
Yeah. So, I mean, they're owning it for the same exact reason. And as the boomer generation starts to die off and this younger generation starts inheriting all this money, I don't think they're going to all of a sudden turn to buying gold. I think they're going to continue to buy things like Bitcoin to hedge, risk of the dollar and, geopolitical risk and things like that.
Okay. So if you're thinking about it though, guys, like anything else, Matt, if it's a speculative thing you want to get into or whatever, you just want to have a little something in your pocket, so to speak. What's some rules? What's some things to keep in mind?
Well, before we even get into that, let's look at the gold price versus the money supply, and that's what Steve was just saying there, talking about how Bitcoin is digital gold. It's digital gold because it goes up along with the money supply. So the more governments are just keep printing and printing and printing money, the price of Bitcoin is going up. So is the price of gold. So they are both. That's kind of their primary hedge is to government spending. And that's why we've seen the price of gold take off really year to date. It didn't move a heck of a lot in 2021 and 2022. And we were looking at inflation and we're kind of scratching our heads going, this is the prime environment for gold to take off. Why is it not moving? And it just took a couple of years, evidently.
But what happens when we stop printing money? No one's worried about that.
Well, first of all, bite your tongue because, there's certain sectors of the government that they're aghast. They're clutching their pearls. They never will stop printing money, Yeah.
And then it's funny. It's like, why do you own these things? There's a finite supply with Bitcoin and gold. And I mean, an argument can be made against both, I guess. I mean, with Bitcoin, they're going to issue 21 million. That's it. You have some people saying, no, they'll continue to issue. It won't stop. But a lot of the true Bitcoiners go, absolutely not. I mean, there's going to be a finite supply. It is going to be 21 million. There's a ton of value there. It's not like the dollar where they can continue to print and devalue it. And inflation's going to be a major issue. And then, you got gold and it's like, well, there's a finite supply there. Well, you ask this younger generation and they go, no, there's not a finite supply. We're just going to go off Earth and we're going to start mining asteroids. Elon said so. So,
which, yeah, 10, 15 years ago, that would sound completely ridiculous. But now we have Elon Musk essentially parallel parking rockets. And it's like, okay, well, maybe this whole mining asteroids thing, maybe it'll be something that actually happens. So I actually asked ChatGPT, I said, tell me what year you think the first asteroid will be mined for precious metals. Guess what it said?
2026.
Oh, no, 2045. So,
oh wow, okay,
a couple decades away. But
okay, so I was shooting for the moon.
You never know.
Like Elon.
You never know. Yeah, it could be 2026.
I don't know. I gotta say, I think you just dropped the quote of the podcast. I feel like parallel parking rockets. It feels like a heck of a great quote. So I don't know. You might should
also,
send that to him.
I had a conversation with artificial intelligence. If you'd have told me that 10 years ago, I would have laughed at you.
Okay.
We're living in a different world.
Yeah, fair enough. All right, so back to the gold conversation. So do we talk about some rules or what do we do?
Yes. So rules for owning gold, and we're not making the argument that you shouldn't own gold. It's just that you need to be reasonable with it. So rule number 1 is don't allocate too much. So we always say own 0%. That's fine, up to 5%. If you want to get really crazy with it, maybe you can go a little bit higher than 5%. But you need to look at it as a hedge to inflation and currency risk. So we consider gold to be an alternative asset class. There's a handful of alternatives out there, but gold is kind of the primary driver there. We consider alternatives to be like Advil. When you have a headache, you can take 1 or 2 Advil. You don't want to take 5 or 10 Advil unless you're
no,
Steve
that wouldn't be good.
Well, I'll have to take 5 of them if someone comes in and asks me if they should put 25% of their portfolio in gold. Like Matt said, treat it as an investment, under 5%. It's just like any other stock. We'd never recommend you put 25% of your portfolio in a specific stock. Treat gold the same way. It's an investment, under 5%. Don't treat it as insurance. Where I start to go crazy is when someone comes in and goes, I want to buy it as an insurance policy for the end of the world. I was watching Walking Dead for like 5 hours, just binging it. Then the news came on. That was even crazier than The Walking Dead.
Yeah,
and
right.
then these commercials saying, just trade your IRA in for gold. And it started to make sense to me. It's like, no, pump the brakes. We don't want to do that. We're talking under 5% in the gold. We want to own it as an investment, not as insurance for the end of the world.
Wouldn't you be better off with bullets and butter? Than you would be with.
Well, that's a conversation. If we're going to get weird today, that's a conversation that we typically have. It's like, all right, well, let's say we do have an apocalypse and a post-apocalyptic world. How do we even know there's value with gold? Wouldn't you rather have MREs and ammo and weapons and
water?
Booze and cigarettes are probably more valuable than gold at that point.
Yeah. Prison rules, booze and cigarettes.
Yeah, so rule number 2, don't own it out of doomsday, end of the world, apocalypse fears. Okay. And then rule number 3 is going to be avoid actively trading it. So going long, going short, trying to get in and out and timing it because it's a speculative asset. You're betting against the kind of the herd mentality, which we're seeing right now, everyone piling into it. But now maybe it's kind of at the end of its run because it's gone up 40% in the last year after being suppressed for a matter of years before that.
Okay. I mean, that makes sense, certainly. So if you have 3 basic rules there again to, if you're going to want to own some gold, how do you do it? So besides Costco, which is out of stock.
Yeah, you can't get it at Costco, but direct ownership. So that's going to a gold dealer. It could be online, could be in person, could be a jeweler. But that's just owning the physical coins. Now, the con there is you have to store it at your house. So you have to buy a safe, potentially insurance. You have to deal with spread fees. So when you buy gold, you're not paying the spot price. You're paying the retail price, which is going to be high because of dealer markups. Okay. And that's when you buy and when you sell. And then another con is when you have the physical gold, you owe taxes on any gains, and it's actually at a higher rate than long-term capital gains. So even if you hold it for a year, the IRS considers gold to be a collectible. So that's where you own. It could be as high as 28% instead of 20% for long-term capital gains.
Interesting. That's a nice little useful nugget, no pun intended. I would assume ETFs is probably the easier way to do things.
Yeah, it's certainly what we recommend. And Matt made a great point. It's taxed at collectible rates. So if you're owning it inside of a non-qualified account, make sure that you are aware of that. One thing that is, I guess you could say in this case, a pro for gold is it's not going to spit off any type of dividend. So you can just continue to hold that gold in a non-qualified account. You're not going to have to pay any type of gain on it until you sell it. So if you plan on holding it for 10, 15, 20 years, it's not going to impact you too much. If you do plan on selling it, recommend that you probably buy in an IRA if you're going to try to get in and out of it. That way you're not dealing with these tax issues. It's all pre-tax, so you can go in and buy and sell. And it gives you a little bit more flexibility in there without having to pay the tax bill every time.
Yeah, and so I mentioned the collectibles rate for direct ownership. That also applies to ETFs if you are owning it outside of an IRA. So if you do plan on selling it, that's something to keep in mind. But it seems like when someone buys gold, though, they're not planning on selling it anytime soon. But then the third way to own gold is owning gold stocks. And I think we all know you're not going to get the same exposure to gold by owning the stock because you're subject to the risk of that actual company, whether they're doing better, whether they're doing worse. They could have a strike, who knows? So it's not ideal, but then the taxation of the gold stock is going to be long-term capital gains. You get rid of that collectibles issue. So some people gravitate towards the stocks for that reason. And then the pro for stocks and ETFs is you have really tight spreads. So just like when you're buying and selling Apple stock or an index fund, you're not going to be paying a big dealer markup or big commissions to get into these products in or out. So that's the big con with physical ownership is you're paying that spread, you're paying potentially a commission, and then you're paying that both ways in addition to the taxes. So that's where you can really find yourself not getting that true appreciation that you'd want with that gold hedge.
That's why we're typically seeing so many clients go the route of just ETFs. I mean, they're such low cost, 0.1%. You have that gold exposure. The only time we're really seeing clients say, hey, I want to pull out $30,000 and buy gold coins is honestly end of the world type insurance. If something happens, I want something to barter with at that point.
So with this conversation about gold, guys, and again, we've got the ebook. Check the show notes for the description to take a link to go check out the ebook and then make it easy for you. Will this apply to precious metals across the board? I mean, I guess the same kind of conversation if you're thinking about like I want silver or I want whatever.
Exactly right. So you're just going further out in the risk spectrum. So if you go silver, copper, all that, they're all useful precious metals. Gold is the primary one. So that's where it's got an 18 trillion market cap. I'm not sure where silver's at these days, but all of them. But gold is the one that you see commercials for relentlessly right now, all these gold and IRA advertisements. So we've had a couple of clients ask about them, and that's where we say, yeah, you can do that, but you're going to have to pay for an IRS compliant vault if you're buying gold, physical gold in an IRA, because the IRS doesn't want you custodian your gold, and you're dealing with the opportunity cost. So if you put gold in your IRA, well, now you can't own stocks or bonds in that IRA slot. And those are great because they pay dividends or interest. And if you take that stock or bond, move it over to your after-tax account, now that's going to show up on your tax return and be a little bit more of a drag for you.
Yeah, so a lot of good nuggets of information this week on the podcast, and I'm sorry to keep hitting that pun, but it's really easy. But it really is true. Like there was several things in this week's podcast I didn't realize about gold, and I think a lot of people are going to be the same way. So do yourself a favor, go check out the link, go check out the ebook. Just click on the link we got in the show details, the show note details there for you below. It's at retirementapproved.com for the newest episode. And don't forget to subscribe to us on Apple and Spotify and YouTube. Hit the thumbs up button and the notification bell and all that good jazz so you can catch more nuggets of information from the guys, and we'll be back with another episode of Retirement Approved here pretty soon. And I guess maybe we'll talk about the new president if we, whatever that looks like, but we'll see. Thanks for hanging out with us on Retirement Approved as always with Matt and Steve Paul. We'll see you next time here on the show.
Retirement Approved is brought to you by Richard W. Paul & Associates, an SEC-registered investment advisory firm. Throughout the presentation, we may generally discuss different financial vehicles. However, nothing we say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments or insurance. For full disclosures, check the show notes of today's episode.